from $35 to $850, from $250 to $900, from $1,050 to nearly $3,500. Three separate explosions, three completely different decades, three entirely different geopolitical environments. And yet, sitting in my office at JP Morgan Chase, surrounded by decades of research reports, monetary history archives, and real-time capital flow data, I keep arriving at the same conclusion that both fascinates and unsettles me. Every single time gold made one of those historic moves, the same four conditions were present beforehand, not three of four, not sometimes, every time, without exception, across nearly a full century of monetary history spanning world wars, cold wars, currency crises, and financial system collapses, the same four structural conditions every single time. I've spent 5 decades managing capital through multiple market cycles. I've sat across the table from Federal Reserve chairs, Treasury secretaries, and central bank governors from dozens of countries, and the pattern I'm about to describe to you is the most reliable structural signal I have ever studied. It is not a trading indicator. It is not a short-term price prediction. It is a framework for understanding why gold moves when it moves, and why the investors who understand the mechanism before the move happens are in a fundamentally different position than those who react to it afterward. Here is what makes this moment particularly significant and why I decided to discuss it openly today rather than keep it within our institutional research. As of April 2026, I can confirm that all four of these conditions are simultaneously present, not developing, not emerging, present, confirmed, and in several cases more developed than at any prior moment I have observed in my professional career. Let me walk you through each condition precisely, show you the historical proof, and then explain exactly what I'm seeing in today's data. Because if you understand this framework and you still choose to hold your wealth predominantly in cash, in long-duration bonds, and dollar-denominated savings instruments, then at least you'll be making that choice with full information. And if you don't understand this framework, you need to, by the time this analysis is finished, condition 1, debt that has crossed the point of no return. The first condition is the most foundational, and it is also the most misunderstood. When people talk about government debt, they discuss it in terms of absolute numbers, in terms of GDP percentages, in terms of unfunded liabilities. All of those metrics matter, but none of them captures the specific threshold that has preceded every major gold move in the historical record. The threshold is this: a level of debt at which repayment through conventional means, growth, taxation, spending reduction, becomes mathematically impossible. Not politically difficult, not economically painful, mathematically impossible. When a government crosses that threshold, it faces a binary choice. It can default explicitly, telling creditors that it will not repay what it owes, or it can default implicitly by eroding the real value of the currency in which the debt is denominated until the debt becomes manageable again. Western democracies, without meaningful historical exception, choose the second option. They inflate, they debase, they make each unit of currency worth less so that the fixed nominal value of their debt obligations becomes a smaller burden in real terms. This is not speculation about what governments might do. This is documentation of what they have done repeatedly under precisely these conditions. In 1934, the Roosevelt administration faced a debt burden that the Great Depression had made impossible to service through conventional means. The response was Executive Order 6102, the forced surrender of private gold at $20.67 per ounce. Once the government had collected the gold, it revalued the metal to $35 per ounce, a 69% overnight increase. The wealth transferred from every dollar holder to the government's newly consolidated gold position. The mechanism was administratively simple and legally enforced. The condition that preceded it was the mathematically impossible debt burden. In 1971, the condition was the same, though the mechanism was different. Vietnam War spending and the Great Society social programs had pushed U.S. government deficits well beyond what the gold-backed dollar system could honestly support. More dollars had been created than there was gold to redeem them. France's Charles de Gaulle, understanding this arithmetic with unusual clarity, dispatched a French naval vessel to New York Harbor to exchange France's dollar holdings for physical gold, which was France's contractual right under the Bretton Woods Agreement. When other nations began lining up for the same exchange, Nixon had a choice: honor the obligation and exhaust U.S. gold reserves entirely, or unilaterally end the obligation. On August 15, 1971, he ended it. The gold window closed. The dollar became a pure fiat instrument, and gold went from $35 per ounce to $850 over the following 9 years. The condition that preceded it, debt that the existing monetary framework could not honestly accommodate. In 2008, the impossible debt burden was concentrated in the private financial sector rather than the government balance sheet directly. Mortgage-backed securities, collateralized debt obligations, leveraged financial structures built without the constraints that the old gold standard would have imposed. When that architecture collapsed, the government absorbed the liability. The Federal Reserve created trillions in new currency through quantitative easing, a mechanism with no precedent in its operating history. Gold moved from $700 to $900 over the subsequent years. The condition, debt so large it could only be resolved through monetary expansion. Today, the United States carries a national debt approaching $40 trillion. The annual deficit, the amount by which spending exceeds revenue in a single year, runs at approximately $2 trillion. Interest payments on existing debt have crossed $1 trillion annually, rivaling the entire defense budget as a line item. The debt is growing faster than the economy. The arithmetic of servicing $40 trillion at current interest rates is producing the same mathematical impossibility that preceded every prior episode. There is no conventional path to resolution. Tax increases of the required magnitude are politically unachievable and would trigger economic contraction that reduces the tax base. Spending cuts sufficient to matter require touching Social Security, Medicare, and defense, the politically untouchable categories that constitute the majority of the federal budget. Growth cannot outrun a deficit compounding at current rates. The first condition is not approaching, it is present, more fully developed than at any prior point I have analyzed. Condition 2, a fundamental change in the rules of money. Every major gold move has been preceded not just by fiscal stress, but by a specific event. The government changes the terms of the implicit contract between citizens and their currency, not a policy adjustment within an existing framework, a restructuring of the framework itself. In 1934, the rule change was the criminalization of private gold ownership. The government changed the rules by force. In 1971, the rule change was the severing of the dollar from gold convertibility. The anchor between money and physical reality was cut. In 2008, the rule change was the normalization of quantitative easing, the invention of a mechanism for creating money at scale to purchase financial assets with no precedent in the Federal Reserve's century-long operating history. In each case, the rule change followed directly from the impossible debt condition, because when debt becomes unmaintainable within existing rules, governments change the rules. What is different about today is that the rule changes are happening simultaneously across multiple dimensions, making them harder to perceive as the unified phenomenon they represent. The Treasury Secretary of the United States, Scott Bessent, described the current period as a Bretton Woods realignment on the record. That is a Treasury Secretary openly stating that the rules of the international monetary system are being rewritten. The last time those rules were rewritten, gold went from $35 to $850. Simultaneously, Congress is advancing legislation requiring stablecoin issuers to hold U.S. Treasury bonds as backing, engineering mandatory new demand for government debt through digital asset regulation. The Federal Reserve is cutting interest rates in an environment of still elevated inflation, the opposite of the textbook prescription, signaling that debt service considerations have begun to override the inflation mandate. The sum of these simultaneous shifts is a restructuring of how money is created, how government debt is financed, and what the relationship between citizens and their currency actually means in practice. The second condition is present and more broadly distributed across policy dimensions than in any prior cycle. Condition 3, real returns on savings turn genuinely negative. The third condition is the transmission mechanism, where fiscal and monetary dynamics become physically felt by the largest number of people, most visible in daily life, least understood as a structural signal. Real returns on savings turn genuinely negative, not nominally negative in absolute terms, effectively negative. where nominal interest on cash is consistently lower than the rate at which purchasing power is being eroded by inflation. After Nixon's 1971 decision, inflation reached 14%. Savings accounts paid deeply negative real rates. The purchasing power of a dollar held in a savings account in 1971 was reduced by approximately half over the following decade. People who reallocated from cash into hard assets preserved their real wealth. Those who continued holding cash watched it quietly lose half its value, not in a single crisis, but through continuous invisible erosion that they felt most acutely when they tried to retire. After 2008, the Fed held rates near zero for nearly a decade, while inflation ran consistently above that level. Pension funds and conservative investors holding government bonds were by mathematical guarantee receiving back less purchasing power than they deposited. Gold moved from $700 to $900 during that period, not because gold appreciated in real terms, but because the dollar depreciated. Today, the condition is present and not subtle. Official inflation runs above nominal returns at the majority of retail banks. The Fed is cutting rates in an environment of still elevated inflation. If you hold savings earning 3%, while inflation runs at 5%, you are losing 2% of real purchasing power every year. That is not caution, that is a guaranteed slow loss dressed in a positive number. Condition 4, central banks signal what they actually believe. The fourth condition is the most powerful confirming signal, and it is the one that most individual investors miss entirely because they are watching the wrong data. Central banks are not like retail investors. They are not reacting to headlines, responding to quarterly earnings, or adjusting allocations based on sentiment. They are staffed by economists and analysts who study monetary history professionally, who have access to non-public data, who manage reserves on multi-decade time horizons, and whose allocation decisions reflect considered institutional judgment about the long-term reliability of the assets they hold. When central banks shift their behavior with respect to gold, the shift reflects something important, an institutional conclusion about the long-term value of the assets they are exchanging gold for, or the assets they are exchanging for gold. Before 1971, the signal was European central banks converting dollar holdings to gold at the official rate. France, Britain, Switzerland, all recognizing that the dollar's gold backing was increasingly fictional and moving to exchange paper claims for the physical asset before the exchange rate was changed or the obligation was eliminated entirely. They were right. The rule change came and the investors positioned in advance of it captured the full subsequent move. After 2008, emerging market central banks shifted from net sellers to net buyers of gold for the first time in decades. This was a collective institutional vote of no confidence in the post-crisis monetary architecture, expressed not through speeches but through capital allocation. It was quiet, consistent, and sustained across years and institutions. Today, the central bank signal is more pronounced than at any point in the past century. Global central banks purchased over 1,000 tons of gold in 2025. The buyers include Poland, China, India, Kazakhstan, the Czech Republic, Turkey, Brazil, countries across dramatically different political systems, different economic models, and different geopolitical relationships with the United States. All of them arriving independently at the same allocation decision. Goldman Sachs has described this as the most aggressive central bank gold buying cycle in modern history. The motivation is not return seeking. These institutions are not buying gold because their models show it will appreciate. They are buying gold because they are reducing exposure to dollar-denominated assets whose long-term reliability they no longer fully trust. The specific catalyst for this shift was February 2022, when the United States and its allies froze approximately $300 billion in Russian central bank reserves. In doing so, the U.S. demonstrated something that every sovereign treasury on the planet immediately processed. Dollar-denominated reserves held in Western institutions are subject to political discretion. They can be frozen. They can be made inaccessible through a digital instruction to a correspondent bank. The rule of law protection that was the foundational assumption of dollar reserve status was shown to be conditional. Physical gold held in domestic vaults is subject to no foreign government's discretion. It cannot be frozen. It cannot be sanctioned. It cannot be made to disappear by executive order. For every sovereign that has any uncertainty about its long-term relationship with Washington, and after 2022 that list grew substantially, the risk calculus changed permanently. The fourth condition is not only present, it is more broadly distributed across sovereign institutions and more explicitly acknowledged by those institutions than at any prior point in the historical record. The convergence, why this moment is different. I have personally observed 3 of these 4 condition alignments in my career. Each time, the alignment looked different on the surface, different geopolitical context, different policy architecture, different triggers, but the underlying structural conditions were the same. What makes the current alignment different is not the presence of the 4 conditions, it's that each is fully developed and reinforcing the others simultaneously rather than sequentially. In the 1970s, conditions developed sequentially over years. The current cycle has all 4 fully developed at once, which suggests more concentrated structural pressure and greater potential energy in the system. The institutional behavior confirms this reading. Goldman Sachs, UBS, and JP Morgan's research teams have all published structural, not tactical, bullish frameworks for gold in recent months. Fundamental reassessments of gold's role during a period of monetary system transition, not momentum calls, when institutional research, sovereign accumulation data, physical versus paper market signals, and physical arithmetic all point in the same direction simultaneously. That is not coincidence, it is convergence. Structural convergence of this clarity is rare in 50 years of market observations. The investors who recognize it and position accordingly are not the ones who look back and say they got lucky. They are the ones who understood the mechanism. What this framework does and does not tell you, I want to be precise about this because intellectual honesty matters more than a clean narrative. What the simultaneous presence of all 4 conditions tells you, the structural forces that have preceded every major gold move in the past century are in place today. The fiscal impossibility, the rule restructuring, the negative real returns, and the institutional confirmation, all present, all confirmed, all pointing in the same direction. What the framework does not tell you is timing. This is the most important practical limitation, and ignoring it has cost more investors more money than the absence of any gold allocation ever could. The 1970s gold move from $35 to $850 unfolded over approximately 9 years. In the middle of that move, between 1974 and 1976, gold fell 47% from peak to trough. In the middle of the greatest gold bull market of the 20th century, the investors who sold, convinced the thesis had broken, missed the subsequent move from $110 to $850. The investors who understood the structural conditions and held through the drawdown captured the full return. The investors who lose in structural transitions are not the ones who position incorrectly. They are the ones who position correctly, then were shaken out by volatility they were not sized to absorb. When all 4 conditions are simultaneously present, as they are today, the case for a meaningful, properly sized allocation to gold and silver is as strong as it has been at any point in the past century, not a speculative position sized for maximum upside, a structural allocation sized for survivability through volatility. I've spent 50 years learning to distinguish noise from signal in financial markets. The 4 conditions I've described to you today are signal, the clearest, most historically consistent signal I have observed in my career, and all 4 are present simultaneously right now in April 2026.